All right. Welcome back to October, and welcome to the Big Skinny with me, Lou Basenese, your host, with hopefully a lot of information that is useful. If this is your first time joining us, you're probably wondering, what in the hell is this Big Skinny all about? Well, let me tell you what we're not about. Urban Dictionary defines Big Skinny as insider information. That is not us, folks. But that definition also goes on to say it's the essential information, the truths. That is what we're all about. We want to give you the essential information that matters when it comes to matters of making money in the market, because I know something that you know all too well. We're inundated, flooded, overwhelmed with a gargantuan amount of information and emails telling us where to invest, how to invest, why not to invest. And folks, I just got to be honest with you. You got to sort through the noise to get to the money-making insights, and that's what we're all about. We do it in a very straightforward format. Some people have called it the Sports Center of financial news. I'll take that, giving you the highlights of what matters, but we do it really straightforward with one headline that you should probably ignore because the mainstream media gets it wrong most often. Then we follow that with one chart that has the key data that should drive your decisions. And last but not least, we serve up one investing insight and action to take so that you can put the information to work to increase your portfolio. And all along the way, we ask you to join the conversation. That's right, we're live streaming on X, LinkedIn, YouTube, and we used to be on Rumble, but I don't know, it just didn't, we weren't rumbling there, so we got off of it. But don't be afraid to ask us anything, right? If you throw some barbs, don't get mad if we throw them back, but let's be constructive. Hit us with your best shot, cue up the Pat Benatar as we go through this. And then also, I wanna really drive home the point that I talked about. We end with one investment insight. It's not just my insights, because I've learned something in 25 years in the markets, and that's to be humble or be humbled. We don't know it all. So we always bring on two guests, maybe one, most times two. This week we got two, to really learn from their expertise. And I am humbled to have with us Josh Bison this week of Bison Insights, a oil and gas industry veteran. I'm sorry, why did I call him Josh Bison? My bad. I got your company name as your last name. Maybe it should be Josh Bison. No, Josh Young, who is very generous to serve up his insights on X all week long, all the time. I've benefited from them, and I'm hopeful you're going to benefit from them as well today. Our second guest is none other than a friend and also my boss, the CEO of Prairie Operating Co, Ed Kovalik. So we're going to be diving into just the macro, the micro, and everything in between when it comes to oil and gas today. And well, when we get to this week's rundown, you'll understand why. So let's get to it. There's no Adrian here, no screaming for cheap oil, right? Well, actually, the president is screaming for cheap oil. Drill, baby, drill. That whole campaign agenda and narrative is to drive oil prices down, drive gas prices down. And, well, it's taking root in the financial system. This headline coming out of Reuters from Goldman Sachs. Gosh, these doom and gloomers now predicting low 50 oil, right? All the way to the end of 2026. Folks, that's, sounds like it might be a good thing. But remember, I said we serve up the investment insights here, one headline that you should ignore. So why should you ignore this if this could possibly drive down oil prices and gas prices? Well, let's go to a quote from none other than Mr. Inverse Contrarian, James Cramer. He's sold everything oil and gas. Well, folks, if you don't know this, he is a wonderful contrarian indicator. Back in April, he said that there was no reason to be buying Alphabet/Google, and well, that stock's gone on a 55% tear since that time as the regulatory fears and concerns were overbaked and it was just undervalued. That's a name we profited from. So now Jim Cramer's out of oil and gas, and that probably means, well, I'm sorry, the sentiment sucks in the sector. And that, my friends, always smells of opportunity to me, because either you're a contrarian or a victim. Forget what Jim Cramer or the young nerd analysts over at Goldman Sachs are saying about oil and gas. What are industry insiders saying? Well, we get this directly from one of the country's top producers of oil and gas in the Permian Basin, the CEO of Diamondback Energy, saying that there's only so much tier 1 rock. What does that mean? Well, we drill in shale. That's rock. We're getting oil out of rock right now in the country. Tier 1 is the highest quality, the lowest cost, the most prolific producer, and there's not an unlimited inventory of that. And that means As he says, it's going to be harder to see growth at $60 a barrel of oil. And at 50, forget it. It's a harder story, no pun intended. You're not going to be drilling in that rock, and we're seeing that happen right now. So why then is everyone so bearish on oil? Well, folks, it's just part of the cycle, but I want to tell you that the math in the short term, low oil prices are going to lead to an energy crisis in the long term. And Josh Young, who will be on later today, is talking about it. There's a big divergence in commodities and gold prices, and it's acting as if gold is shouting from the rooftops that we should be buying other commodities like oil. We'll get into that with Josh, but I 100% agree. You see the chart here showing the rapid rise. Gold, I believe today hit $4,100 an ounce. We're now trading, the gold to oil ratio is now trading 6 standard deviations above the long-term average. Folks, that's mathematically not something that has a high probability of happening or lasting for long, and here's why. Let's do the simple math. There's just not an unlimited inventory of cheap oil. In fact, if you look at the chart here showing the wells that are available to drill in the Permian, it's not unlimited. If you get below $70 a barrel, you see that we're at 15,000 right at that 70 barrel line, but then it almost drops in half when we get to $60 a barrel. Well, that's where we are, folks. Guess what happens if we get the Goldman's forecast for 50? Only 3,200 wells of inventory available to drill. Now, for those of you not experienced in the oil and gas sector, which was me about 9 months ago, that's maybe 5-6 years of inventory at 3,200. We'd run right through that very quickly, and that would mean that supplies are going to dwindle dramatically. And let's just get to it. So fundamentally, the demand is there, the supplies are there, but just not at these low prices. But let's also focus on in the markets, right? We know the tech sector is rip-roaring, and we've been talking about the AI trade as it relates to energy and data centers, but the tech sector makes up over 35% of the S&P 500. The energy sector, a measly 2.8%. This is continuing to go down. Again, this is an extreme low in the market. We don't need a huge reinvestment in this sector to see a huge re-rate in oil and gas prices. So we go from one headline, ignore it, one data point here that says it's gone too low, gone too far, overstretched. Violator 2020 is asking, is XOM a good stock to start your oil exposure with? No, it's actually not. I don't have anything against Exxon, but I have a better idea. Why try and pick the horse that wins the race when you can bet on all of them at the same time? And that's where it boils down to with this week's Big Skinny is buy the Energy Select Spider. The Energy Select Spider ETF. This is going to give you exposure to 23 of the top oil and gas and energy companies in the country in the S&P 500. That includes Diamondback. That includes Violator 2020, your good old Exxon, and you're going to benefit from any uptick. All we need is a little bit of capital flowing back into this sector to see these prices jump 10, 20, 30% in short order. And look, we were saying that was possible for the AI stocks that we picked maybe 4 or 5 months ago when it wasn't extremely popular. Look at them now. I think if you go back to our stock list of the top 10 AI stocks not named NVIDIA, the average one's up 55%. I think we can be looking at easy double-digit gains in the energy sector if we're willing to invest early and ahead of everyone else, ahead of the herd. So that's the reality check. We're telling you here and now, place your bets because we love being contrarians before the tide turns. And I'm telling you, we're getting close to one of those turning points based upon multiple fundamental and technical indicators and macro indicators. And that's what we're going to dive into in the rest of this episode with our guests, Josh Young and Ed Kovaleik of Prairie Operating Co. So before we get to that, I want to remind you we're live streaming on multiple platforms, so don't be afraid to join the conversation. I also want to remind you to follow us on YouTube like Mr. Beast should, because you don't ever want to miss an episode, and the best way to make sure that happens, that doesn't happen, is if you go ahead and subscribe to our YouTube channel. You get a friendly reminder every week before we go live. So while we go on this quick break and we play something else for you to noodle on, go over to youtube.com, The Big Skinny Live. Click that subscribe button and we'll be right back.
Basenese with me this morning. Look, you know it and I know it. There's been an awful lot of talk about a bubble, an AI bubble or a tech bubble. What's your opinion on bubbles?
There's a bubble in bubble talk. That's my opinion. Is that too many people trying to be the Nostradamus and predict the top, which is just a futile effort. You don't get a prize for accurately predicting the top. You get a prize for staying in the market as long as this bull market lasts. And I would tell you the underlying fundamentals suggest it's going to keep charging ahead into the end of the year and into the beginning of next year.
What's the underlying fundamentals?
So the underlying fundamentals is growth from AI. It's spurring on over 1% of GDP growth per quarter. And what people are failing to miss is when they compare it to the dot-com days, the internet was already built. The fiber optics were there, and there was a bunch of companies that really didn't have fundamentals that were leveraging that. The infrastructure for AI has not been built yet, and it takes years to do that. So we have years of compounding and building and margin expansion and development of new companies that can happen from this trend, and more importantly, the solutions and products that are going to be benefiting from AI.
All that money, I mean, we're talking hundreds of billions of dollars, if not trillions being spent
we're north of
in
$1 trillion.
America.
Yeah.
That adds what, 1 percentage point
each
to GDP?
quarter? It's contributing up to 1 percentage point. So think about 33% of the last.
That's a stimulus program.
Growth. It's a huge stimulus program. It's also wildly deflationary. So it's counterbalancing any impacts from inflation, from deficit spending, and all those ills that everyone likes to point to. Welcome back to The Big Skinny with Lou Basenese, and without further ado, I'd love to bring in our first guest so I can serve up a nice apology for messing up his last name, Josh Young. It is a pleasure to have you joining us here today, my friend.
Thanks for having me.
Yeah, look, Bison, I apologize for that mix-up, but Bison do go right into the storm when one's approaching, and I feel like, based upon the information you share and the fact that you're willing to be an oil bull in one of the times that bearishness on oil has hit a 17-year high, it's an apropos name. How did you get the name for Bison Insights?
Actually, my co-founder came up with it. He's not with Bison anymore, but we worked together for about 5 years, and he used to live in Wyoming, and he was just really into the West. And we kept meeting with people. We didn't have the name yet. We met with them, told them we were going to invest in publicly traded oil and gas companies, and we'd get laughed out of the room and down the hall. And so we figured, okay, we're going to face into it.
No, man, well, that's great. It fits right into it. So, I mean, look, right now, people are laughing at you, at me a little bit. I think you tweeted it out, a fellow commodities resources guy, Rick Rule, who's been a mentor to me in the business. I told you, I responded, he used to say you're either a contrarian or a victim in the markets. And he said recently a quote that you said, he loves to buy things when they're hated, and oil's hated right now. So why do you love it so much, to start things off?
Well, I love it long term. I sometimes I'll comment on, hey, what do I think is going to happen in the next 3 months, 6 months, whatever. Honestly, I don't know. And I sort of like to joke that my short-term crystal ball is broken. So I honestly don't know what's going to happen in the near term, and I'm not sure anyone does. But in the longer term, what we've seen is, over the last decade and almost 15 years now, underinvestment in oil exploration. And so just like you're seeing with gold and silver and some of these other commodities where they've gone up a lot after people spent very little building new mines or drilling for new mining prospects, so too for oil. As you deplete the oil that you've discovered, it gets more expensive and harder to produce, and it means that the price is probably going to go up a lot, and it's just hard to tell exactly when.
Yeah, it's hard to time it, but we were talking in the intro about it. If you look at just the ratios to gold and other commodities, I mean, you had that great chart showing gold to the commodity index, which obviously the commodities includes things outside of oil, but how overstretched are we from your experience? I mean, you've been in this industry for a long time. How many times have you seen? I mean, outside of COVID, right? That was the most extreme case that we saw. But what's happened after other divergences like this in your history?
Well, COVID's a great example, right? We're almost as disconnected right now between gold and oil as we were then. And if you bought oil, if you ignore the negative, you've bought oil stocks during COVID, anytime around when the ratio was around where it's at now. With the bigger stocks, you were up a few X. With the smaller ones, I mean, we were up some ridiculous percentage, 10X plus on some of the stocks that we bought in 2020 by 2022. So I think you don't have to look that far back to see what this means. And, there's no guarantees. It's possible this time's different, but if you look back far enough, you'll see almost every time that gold has gone up like this, you've either already had oil go up a lot or you're about to have oil go up a lot.
Yeah, and if we think back, I mean, to COVID, right, there was legitimate demand destruction that happened then, right? The world shut down, global economy started cratering. I mean, GDP growth went negative pretty much everywhere. Fast forward to today, though, that's not the case, right? I mean, what's your take on demand and the various headlines we're starting to see now about demand increases versus demand destruction?
Yeah, so the reason for a crash or the reason for poor price performance is always different. Every cycle has its own narrative, it has its own downsides, and it has its own reason for the down cycle to end and the up cycle to begin. And then you get these things sort of exaggerated at extremes at the very end of the cycle. So the story around demand destruction was really big around COVID, and then we saw demand come back and the world reopened and oil prices went from -40 at their low to, I think it was around 130 or so at their high in 2022. So right now, the story is less about demand, which is obviously growing and it's beating expectations right now, both in the US and globally. It's more about supply, where there's this concern that there's going to be several million barrels a day more production on by early next year versus what we saw early this year, and that would lead to a multi-million barrel a day glut. So that's sort of the thing that people are really worried about.
And
that's
where,
what's weighing on
where are
prices.
they wrong in their thinking, though? Because if I look, demand from China, we're not going to go into a global recession right now. I have a hard time seeing where the demand destruction is, and I think Bloomberg was out with an article too showing that we're not anywhere near peak oil demand. Actually, BP and other agencies are revising out their peak demand to 2030 and beyond, which this year was supposed to be the year demand peaked, right?
Yeah, I mean, I love that chart because they'll say it's scenarios and then they pretend like they weren't forecasting this, but they used to just not show a scenario where there was demand growth. So it's like, okay, sure, technically it's not a forecast, but if you'll only allow for demand falling, then you're clearly giving a forecast that demand would fall. Again, it's not about demand falling, it's just about how much will supply grow and then how much will demand grow and how quickly will each of those grow and then when will they end. And so my view is that supply will struggle to meet expectations. And the more we grow production, the harder it is to sustain production because we're in this environment where there's been underinvestment for so long. And that's the part I think people have so much trouble with, right? Is that if you underinvest, if you don't do the things you need to do 10 years ago, then every day gets harder and harder and harder. And that's the part really people I just don't think appreciate. This is a great
let's
chart.
spend a minute there because it took, you may or may not know this. I was always a lifelong tech guy. I got into the oil and gas industry at the beginning of the year. And that was one of the biggest revelations to me that, you just read the headlines and you think that there's unlimited supplies for us to keep increasing productions in the Permian. But then the shale decline rates are so rapid, 50% in year one. Why don't you explain that? You're almost essentially, if you keep increasing production, you get yourself on a treadmill here, right? And it's inevitable that if you don't invest in more discoveries, that you're just going to see declining rates. But why don't you articulate that so people understand it better? I know I didn't when I first got involved.
Yeah, sure. So these decline charts are helpful. Again, there is reinvestment, so it's not like there's no new production coming on. But the reason this matters so much is that a rising percent of production is coming from the high decline shale fields, and a falling percent of production is coming from conventional low decline fields. And then also, even in these conventional low decline fields, once they go into decline, they can start falling a lot. And so there's various different kinds of reservoirs. The water contact ones are the best, the water drive ones, where you basically have water pushing up and the pipe comes in the top and basically the water forces the oil up, and then at some point it's just water. And so you go from, this is what happened at Cantarell, you go from millions of barrels a day to thousands or hundreds of thousands of barrels a day, and production really collapses. So you need more and more replacement, and that means you need higher prices in order to induce that activity, and that's just not happening right now. So again, could it go lower? Sure, right? It's possible, anything could happen, but eventually you're going to need much higher prices to make up for these problems, and the lower it goes, the faster and the higher it should go.
Right. So you're of the conviction that lower prices today lead to an energy and higher crisis and higher prices tomorrow, essentially, with tomorrow being in brackets. It could be 3 months, 6 months, 9 months from now. Where do you think it has to go? I mean, forget inflation adjusted prices, but now I'm seeing headlines from Enverus saying that shale prices need to go to 70 to, or for shale to be profitable in the Permian, 70 to 95. Diamondback CEO has been very outspoken about dropping rig counts as oil prices have fallen. So where do you think that equilibrium is, the sweet spot for oil prices for production in the U.S.?
Yeah, I mean, there's this popular TV show where they have this guy rant about how oil should be around 70 or so, which is complete nonsense. Oil needs to be way over $100 a barrel. And the way you can tell is you just look at the financials of these companies, and every one of those, when you look at them and you strip out one-time gains and you strip out all this other stuff, and you look at the actual profits that they generate versus the real costs, not the written down costs and not the sort of artificial balance sheets that they're holding, but the full cycle costs. In order to engage in the next bull market in terms of drilling activity and production growth, you need much higher prices, not a little bit higher prices. And so, again, I think people have recency bias, and we were huge beneficiaries of the technology gains and the efficiency gains of the US shale industry. Those are mostly in the rearview mirror, and we're seeing increasing problems. And yeah, sure, like it takes time. I like these images you guys are showing. It's it's tough, right? Like,
and I think hard to this is actually
well, this is partly why it matters so much to know which stocks to buy, because some of these things you can just get destroyed, and some of them I've owned, but fortunately, a lot of them that I've owned have actually done quite well despite this challenging environment. And that's really my day job, is to try to figure out, hey, how do I make money overall in this, both while oil prices are not doing so great and when they eventually go much, much higher. So
I want to get into your strategy. I want to get into your strategy in a little bit, but I want to articulate this some more too. I don't know that everyone realizes that, right now AI is the topic and trend of the day, the week, the year. But collectively, the AI trend only generates about, I think the stat I saw was about 80 or 90 billion in revenue right now from actual, but if you look at the oil and gas space in terms of cash flow per employee, in terms of total revenue generated, it's $1.5 trillion or more dollar industry each year in the US alone. Why are people, like, I got to believe that you can find opportunities in good markets and bad because of the fact that we're really manufacturing, right? You're getting a product out of the ground and getting it to market. The ones that can do that efficiently will always make money in an up market or a down market, right?
Yeah, I mean, I think partly it's that, and partly in financial markets generally, there's almost always things that people hate and almost always things that people love. And generally the things that people love, they love too much and they're too expensive. And generally the things that people hate, not always, but some of those things can actually be really mispriced to the downside and should potentially actually trade a lot higher. And so a lot of it's just doing the hard work of sifting through the wreckage essentially through oilfield services and upstream and so on. And so, yeah, it's less about, I think those revenue metrics sort of matter, but the reality is that AI is growing a lot faster than oil is growing. So it makes sense that those valuations would be higher, but it's not about, hey, this oil company should trade like an AI company. It's that this oil company should trade at a reasonable valuation based on
not like it's going out of business.
Cash flow.
Right.
Exactly.
So let's talk your strategy. I mean, because you run your own fund and money, but you also have a subscription-based service where you share ideas with everyday investors, anyone that signs up, the subscribers. I'm a subscriber. I recently had the note out where one of the Canadian plays was up 45% on an acquisition before you got a chance to recommend it. But how are you looking at the universe of potential opportunities to find compelling investments right now? That, where are they located in the market geographically, market cap size, just, in a nutshell, what's your approach?
Yeah, that was me whining a little bit about, we were like halfway through that write-up.
Dude,
it was like,
I've been there. I've been in the publishing business. Nothing worse than when you put the time and effort into it and you before you get to hit send, it's gone. The opportunity got realized already, so.
Yeah. So I've been investing professionally in publicly traded oil and gas companies since the last time it was popular, or maybe the time before that. So for too long, and launched Bison in 2015 with a co-founder who's now not with Bison anymore. And we invest in small, publicly traded, mostly upstream oil and gas companies. We'll also invest in services and in midstream. And then very rarely and selectively, we've had small private investments in mostly upstream oil and gas companies. So that's my one hat. And then the other hat I wear I launched this blog newsletter thing via a separate media company where I share ideas of companies that I typically own stock in. Sometimes my fund will own it, sometimes my fund won't. And the thought there was just I have all these social media followers, and I see all of this, unfortunately, a lot of really bad advice and really bad suggestions. And I've tried to use social media to help educate people and share sort of what I'm doing and what I see. And it seemed like another way to go ahead and share these ideas systematically and in a compliant manner.
Yeah, no, listen, I came out of being a FINRA regulated investment banker, so I understand the compliance difficulties of doing that. I do want to give you credit and encourage everyone to follow you on X. You do a tremendous job of, one, sharing the data from others and then actually providing some perspective. I find there's a lot of people on social media that are just takers. They don't give any information. They just take it from others. You are very generous in that, so I encourage people to follow you. Right now, what do you think is the biggest misconception that's keeping people from investing? I mean, we showed the chart before. S&P 500, the weighting for energy right now is at like 2.8%, 3%. Now, like it's been trending down, and it doesn't look like it's bottoming anytime soon.
Yeah, I think the IEA, that other chart you showed where they finally added a forecast that demand's growing, they've really not done anyone any favors, because they basically gave this industry an idea, they give it a tarnish that it's going away. And I think once people realize that it's not going away, it has a shot to go from that 3% or so that you were showing of the S&P back closer to the average level of 10% or so. And again, it's not AI, so it's not the fastest growing. So maybe it shouldn't be 30% here, but at 10%, that's still enormous upside even for those largest companies. And it's wild upside for some of the small caps. So I'm interested in hated upstream companies. I've really gotten interested in drilling rig companies and certain other services, just because there's that physical equipment that you can buy in some cases for pennies on the dollar. So, stuff like that.
Yeah. I had another question for you. It just escaped my mind. Oh, here it is. The bear side. Is there a technological angle that they'll say that, listen, we didn't have hydraulic fracturing. We couldn't go horizontal drilling, 10, 15 years ago. Now we're going out 3-4 miles laterally. Is there some technology that could disrupt all the economics here and really keep oil prices lower for longer while we increase supply? I mean, do you worry about that for any of the names that you're involved with?
Yeah, I mean, that was part of my motivation to spend significant time on oil field services companies, because the drilling rig companies and the completion companies and the chemicals and, sort of down the list, those are the guys that are going to see that technology first and in some cases offer it. And some of the most fervent oil bulls here, there aren't many, but some of the most fervent oil bulls are the CEOs of some of these technology companies and services companies that, if there was a solution like that, they would be implementing it and they'd be offering it to their clients and they'd be really heavily using it. And so, they're seeing the opposite of that, where they're seeing some of these technologies hitting their limits, things that were growing 10 or 20% a year from efficiency, starting to grow single digits or less. And then the one other thing that I think I hear a lot in terms of a bear thesis is, oh, hey, we'll go do international shale. And people will point to various fields, in some cases Canada, which I know real well. I was the chairman of a Canadian E&P for a little bit, sold it for $100-something million. So Canada has good prospects, but is pipeline limited, and unfortunately has gone pretty far down that sort of socialist regulatory and tax path. So it's really hard for Canada to grow too much. And then people will point to Argentina and certain other places like that, which are similar, but they have a combination of regulatory and tax issues, unfortunately, and risk that they'll get even worse geopolitically, but also the resource. So Canada, the resource is there. Some of those wells are truly fantastic. Argentina, it's not quite there. The costs are still too high. The well productivity is still too low. So I think that the bear thesis, outside of oil's going away, which now even the IEA admits that it's probably not, is on these productivity gains and on these geographies that for the most part are not really playing out.
Yeah, you bring up some important points. I mean, geographically different, the just logistics in certain geographies. I got a question here from Chad Towers for Josh on services topic. Are you long Halliburton or NOV by any chance?
So I happen to not own those two particular ones. My take is generally to look down cap, because similar to what we saw in 2020, you could go buy Halliburton in 2020 and you got a nice, I think it was like a 3x or a 4x, something like that, from the bottom in 2020 up to the top in 2022. Or you could go buy one of these other much smaller companies, in some cases actually with a better balance sheet and a higher likelihood of survival, and that stock might have gone up 10x or 20x or 30x, something like that. So if I'm going to take that risk anyway, I don't necessarily need to own the name brand. And I do like smaller companies. I don't need that high trading liquidity. I just look for the best deals that are most likely to go up and least likely to lose me money. And so that's where, the Halliburtons, they're great. They're wonderful companies, but they just trade at high valuations and they just have limited upside, even in an upcycle.
Yeah, listen, it's music to my ears because I'm a contrarian by trade, but I also love small caps. I've started out in Morgan Stanley's private client group and realized small and micro caps are where you can generate alpha the easiest if you actually do the work. Sounds like hopefully small caps are breaking out, the Russell 2000 finally hitting a new all-time high. So that should benefit the trade here over the longer term as bullishness on oil becomes more ubiquitous, which I think is ultimately where we go. It's a matter of when, not if. Any parting thoughts? I mean, things that you're watching that could on the radar in the next couple of weeks. Do you worry about trade tariff headlines impacting global demand at all, or how is that impacting how you're investing and trading?
So honestly, I hope that we have world peace and I hope that stocks just go up and prices just go up, but I sort of want things to come down a little because I have some cash. I have these companies that are getting bought. And I honestly, if things had gone down this week instead of Trump sort of chickening out over the weekend, there would have been some wonderful additional buying opportunities. And then just the one last thought on all of this is, I think like one of the biggest things to lose on in this space is companies that have too much debt or companies that have to go dilute themselves a lot in order to be able to survive through a downturn. So the companies I've been focusing on have been buying back stock, paying dividends, and generally, for the most part, a few exceptions where they're very levered and then have wildly asymmetric potential upside. But for the most part, companies that are able to sort of do those capital returns at low prices seem to be best positioned to be able to make it to whenever oil prices rise a lot. And if they can buy back shares while their stock is down a lot, then they have fewer shares with potentially the same earnings and same cash flow when prices are higher. So that's sort of been where I've been most focused, is on the return of capital guys rather than the sort of dilute and aggressively grow, but both could work.
Yeah, no, super sharp insights. I appreciate it too, that wisdom. Look, you're not just surviving, you're thriving because you've done it through multiple cycles in the oil and gas space. So that's no easy task in itself. I encourage everyone to go check out Bison Insights from Josh Young. Josh, really appreciate you sharing your wisdom with everyone here today. Wish you the best.
Thanks a lot. Thanks for having me on.
All right, folks, again, the benefit of always getting industry experts on with us is that you just get confirmation of things you might believe, but also articulation and more experience and just explanation of why the dynamics could be moving for or against you. Obviously, you've heard me here on multiple episodes banging the drum for just a resurrection of energy companies and the oil prices, given multiple factors, and Josh really drove that home. So again, I encourage you to give him a follow at the very least. Consider subscribing to his newsletter, and also consider following us on X. Elon would follow us. He said he would, so you should too. And we'll be right back with another industry veteran and my friend and boss, Ed Kovalik of Prairie Operating Co, right after this short break.
Bubbles in every asset class is what you're saying. And I will argue that the fraud you ought to worry about is in the non-bank lenders and private credit and in private equity, because we've already seen a couple of
momentum trades. Just let me say this: momentum trades aren't fraud. It's just you just get in and you get out.
No, I'm talking about the frauds.
I think also is you brought up all these macroeconomic concerns, and my problem being a macro investor is you can get 99 out of 100 variables right and still end up losing money. I think gold and Bitcoin to a degree have become the simple macro trade.
Yeah, I agree.
You can bet and distill down all the macro concerns into one one trade that's also momentum based. I mean, I just started buying gold and Bitcoin for the first time in my life as a hedge with an ETF that gives you exposure to both.
My gold chain is worth a lot of money.
Yeah, my gold chain, but mine's sentimental for my grandmother.
I don't see any gold chains around my neck right now.
We don't bring out the Italian horns until after the show.
Well, I'll tell you what.
Welcome back to the Big Skinny with Lou Basenese, where today we're digging into the oil and gas sector, industry that I've called my home since January of this year, and it's a great pleasure of mine to introduce you to our next guest, who's been in this industry for far too long, seen the ups, the downs, and we're both expectant of a future up. Ed Kovalik, CEO of Prairie Operating Company. Welcome to the show, Ed. Hey,
thanks, Lou. It's great to be on with you.
Yeah, so listen, it's the topic of the day. How low can oil prices go before they rebound? You've seen this, you've lived through up and down cycles. What's your feeling for the sentiment right now, and what really turns us around? What's the pivot point?
Well, the last time I asked myself that question, oil actually went below zero, which I don't think anybody thought.
Don't do that, Ed.
I guess we were paying people to take it. But, it's interesting because consensus now seems to feel like we've got potentially some build growing into the back half of the year. But then, not to worry, there's a supply constraint. OPEC is kind of, at its tips in terms of spare capacity, and demand keeps growing pretty consistently. There's been a lot of talk about China, obviously. But all in all, for a whole lot of reasons, I tend to be a, oil bull, thinking that, it probably should be valued a good $20 more than it is today.
Yeah, and you see that just on the demand and supply dynamics. What if we factored in inflation? I mean, where should oil be? I mean, you and I have talked about this a bunch before.
Yeah.
We've gotten spoiled by cheap oil, and it didn't participate in the inflation trade, so it's undervalued even on real dollar terms.
Yeah, no, that's absolutely the case. If we had the technology to build a time machine and go back to the beginning of shale, when it was developed 20 plus years ago, the whole industry was kind of built on the back of what I'd call, a $65 long-term price for oil. That was before inflation happened. And today that's probably about, $20 of inflation that we've experienced in the last 20 years. So kind of $1 a year.
Yeah.
So today, on a post-inflation basis, we've kind of got like $80 oil. Put differently, on a pre-inflation basis, oil today is really trading at about $40. So it's incredibly cheap.
Yeah, incredibly cheap. Josh Bison, I keep messing up his name. Josh Young from Bison was on before, and he said that, some people are saying the sweet spot's 70, but he thinks it's north of 100. I think we both tend to agree on that. If we get to $100 oil prices, what does that change very quickly? I mean, obviously the profitability goes up, right? But where does that mess with demand and just the economic implications of that? Because I think people now say, and the president himself is pushing for lower oil prices, but that's not necessarily good for the industry, or it's only good for consumers. Where does that balance out if we flip too high to the upside?
Well, what's interesting is that historically in a higher price environment, you saw the industry overproduce. Today, when you look at the whole industry and kind of divide it up into OPEC and then the US and review them differently, it's frankly hard to make a case that the industry would overproduce because, a lot of folks think that OPEC is already kind of producing its max output and that, they've already kind of unleashed spare capacity. So I'm not sure you'd see a lot more productivity out of them. With respect to the U.S., most of the oil we produce in the U.S. is through shale drilling. And the dynamic with shale drilling is that the decline from new wells is really, really steep. So just to maintain our 13 plus million barrels of production daily in the United States, we're having to replace, 40% of those barrels every year. So I'm not sure how much we could really grow, even if we all wanted to capture higher prices. Now, a lot more inventory in the United States becomes economic at higher prices. At these prices today, inventory is really scant.
Yeah, we shared that. I shared that chart before. We can bring it up again on the Permian, right? That you and I have talked about, where under 60 or under 50, forget it. You've got about 3,000 wells of inventory that's available, which really would change the dynamics. So against this backdrop, explain why start, with Gary, your co-founder, why start an oil and gas company roughly 2 years ago, again, at a time when ESG was the buzz of the time, all renewables. It was an energy transition away from fossil fuels completely. I help the audience understand what gives you the guts to do that.
It's funny you asked that, because everybody told us it was so wrong to do that, but it felt so right. And the reason it felt so right is because, there's a scarcity value to the commodity for all the reasons I stated. Now, is there a lot of oil? And, in my opinion, sure. There are a lot of discoveries left to be had offshore and in other locations. But the problem with that is it takes a lot of capital. You're talking about tens of billions of dollars that haven't been invested annually over the last 10 years or so to really develop these, larger discoveries. And then from the time you discover those, you need about 7 to 10 years to bring them on. So I think ESG, that whole narrative, really did a disservice to the planet, because it basically suggested, hey, we don't need to spend tens of billions of dollars a year, on new discoveries and new development, because we're not going to need the oil. Well, fast forward to a future where we need the oil and we didn't make those discoveries, then, as Josh probably kind of voiced, we're looking at much higher oil prices. So, that's why we started the company. We think there's a fundamental scarcity value to the commodity. We're running out of inventory. And, that's why we're trying to get our hands on every great location we can.
Yeah, and so we're not really about exploration. We always say it's exploitation, which has negative connotations to it, if we can get another Asian word in there. But got a question here, kind of long term, right? So you have the genesis of forming the company because there's scarcity and value in that. Where do you build to from Chad here saying, can you explain the long-term strategic plan that's going to restore shareholder value? And what's our accountability for this? I mean, we never tread gingerly. We address this head on. So what do you think of this?
Yeah, no, that's a great question. And look, from the beginning, our plan has been really simple, which is to consolidate the DJ Basin and to build a high growth company, both through acquisitions and through the drill bit. We've done, 8 acquisitions in just the last 2 years, but we're now beginning to grow significantly through the drill bit. We really just started that program in April and May of this year after our last acquisition, which was our largest acquisition. And so we're, really hitting exit velocity going into the back half of this year into next year, where, we see a future where our cash flows start to surpass our CapEx. And we're all about returning capital to shareholders. We ourselves are large investors in the company, large shareholders. We love dividend income. So that's our focus. We're luckily underlevered compared to a lot of peers. Yeah. We have no intention to become overlevered. So, our vision is to continue consolidating, but also to top off and return cash flow.
Yeah, I had a funny one. The producers asked early, should we bring up the stock chart of Prairie? And I said, yeah, sure, bring it up. Ed and I never shy away from it. Then I realized the stock started going down when I joined the company in January. So I think we need to blame me for it. So I'll take all the blame. But against that backdrop, you're sharing, we have a long-term plan here. We're not fast money. This is I look at it, it's like round 2 of a championship fight in terms of duking it out for whether oil and gas is going to be prevalent and higher priced. What do you see? How do you say to the people that, we get the same questions? How do you turn this around? What are the objections people right now say to purchasing shares in the market, and how are we addressing those things?
So at the time we did the last acquisition, which was a $600 million acquisition, it was more than 10 times the size of our company. And so whenever you do a transformative, minnow swallowing a whale kind of a deal, it's tough to finance that. We were lucky enough to get a great bank syndicate together led by Citibank to fund most of the deal. And we were frankly fortunate to have, our preferred shareholders come in for $150 million to finance that deal. Now, was that an expensive transaction? Yes, but deservedly so, because of, frankly, what I just described in terms of how impactful that asset acquisition was. But our perspective has always been that oftentimes you have to do financing for M&A, but it ends up really being bridge financing. And, we have the ability to redeem this financing. We're now significantly larger than at the time we did that acquisition, not only as a result of having done the acquisition, but also because we're growing substantially through the drill bit. And as a result, we have access to lower cost of capital. So, we're working tirelessly to eliminate the overhang on the stock that the preferred transaction has been. Fairly, though, I would point investors to the fact that very little of the preferred investment has actually converted into shares, so it really hasn't been substantially dilutive to date.
Right.
I also respect the fear of dilution, and that's why the stock is trading at sort of a blowdown value, assuming full conversion of the 129 million of that preferred stock left. But we're not really afraid that that's going to happen because we think our ability to take that out is pretty strong.
Yeah, no, I think that's the overhang too, as I talk with shareholders and different investors considering it. So let's go back. I mean, you've been in this industry for a decade plus, banking as well. So you've seen every type of opportunity, over-levered, under-levered. You've also seen real pivot points in the industry. And maybe it's worth explaining to people how quickly conditions can change. I mean, maybe from your past, you can share an experience of where, oil goes from 50 to 75 and stock prices. I mean, Josh was hitting on it, like coming out of the COVID lows, there were companies that were up, 5 to 10x because they got so oversold. And I think that's the situation we find ourselves in today. So what have you seen in the industry in your experience?
Well, what's interesting is that we do go through a real roller coaster ride as an industry because we are tied to, a commodity whose price changes, but we're also tied to, supply, demand, geopolitical risk, and general perception of the commodity in the markets. So today we find ourselves as an industry trading at a historic low multiple compared to any other industry in the S&P. We're the cheapest, yet we generate the highest amount of free cash. So to me, that's sort of a bullish signal that there's a lot of upside from here. Demand for our commodity has increased every year, so that's not really changing. I think that the commodity is really mispriced today. There's been a lot of talk around, does it trade with storage numbers? Well, it hasn't really, because we really bottomed out storage, under President Biden, and nothing really happened to prices. So it doesn't seem to be, storage related. It hasn't been geopolitically related because, you would have never convinced me that if the U.S. bombed Iran, we wouldn't see $100 oil.
No, well, I mean, we were talking Iran when it happened, right? We were talking, it was a Friday, and we were preparing for 100, 120 on Monday, and then we were all shocked that it didn't happen.
Yeah. And so it seems like the financial markets are really what are suppressing the price of oil. You've got a really historic level of net shorts in the market. But none of the facts on the ground really reflect it. So there's fear of this OPEC glut. Well, if there was going to be a glut of oil from OPEC, you would have already seen it in the storage numbers, and you're not seeing them. So I think there's a lag in terms of the market catching up with reality. We're experiencing that lag right now. And make no mistake, based on historic movements, this commodity can shoot up $20, $30 over a very short period of time. I know Josh was talking about the gold to oil ratio. That's really been blown out. So either you think gold is totally overpriced and there's really no reason to worry about, the currency trade, or you think oil is really mispriced to the downside and it ought to be more. Now, I'm all for low prices, but they're really screaming cheap right now. And we don't need screaming cheap prices to fuel this economy. It's not as if $80 oil is going to tank the economy. If our economy can't survive, $20 in oil prices, we don't have a very resilient economy. So, there's a lot of room to the upside from here.
Yeah, no, I agree. I mean, we showed the chart earlier too. Breaking even for the Saudis is at about $90 a barrel. So there's a gravitational pull that's eventually going to go the opposite direction, pulling prices upwards. I appreciate you giving the perspective here about what we're doing at Prairie on the macro view. And look, we had this slide earlier that it was, You just need to be patient when it comes to oil and gas investments. And I find that's often the case with contrarian trades, is you got to be patient because things happen gradually and then suddenly. So just encouraged by the plan ahead. Any final thoughts for any of our shareholders that might be listening right now, or people that are considering looking at Prairie and what you have planned ahead?
Yeah, look, obviously I love our story. I think we're on the right path as a company. We're putting our money where our mouth is. Every window of opportunity we have, we're all buying stock, even though we own a lot of it to date. So, I'm fully bought in. I think our team is fully bought in, and our growth, is going to start showing up here, as we've told everybody. Tail end of this year, a lot of the wells we're bringing on are coming. We've got a lot to sort of talk about in the back half of the year. We remain excited about the M&A environment. We're in a great financial position. We're really well hedged. So, we've got nothing but good things to kind of look forward to as a company. And I think if shareholders stick with us, they'll figure that out as well.
Yeah, well said. Over 11% insider ownership and hedging. That's north of 65 for this year. So even if prices are falling, we're still got cash flows locked in. So Ed, I appreciate you making the time on a Monday afternoon and a crazy market to tell the story and share your insights. We'll look forward to having you back on, man.
Great being with you, Lou. Take care.
Thanks again. All right, folks, there you hear it, both from a lifetime investor in the oil and gas space and now an operator as well. This is the headlines, the information that's not going to be contained in the headlines, and that's why we're bringing it to you here, to get you ahead of the curve, to help you increase your bottom line. With that in mind, we want to make sure, Chad, we want to thank you for participating, always being such a loyal supporter of the show. And yeah, Q&A is always the best. It gets you the context that doesn't come out in press releases. So really appreciative of Ed and Josh both coming to share their information and insights on the oil and gas space. We're going to come back and share insights with you on past calls, past trends that we've been talking about. We're going to welcome the man, the myth, the legend, the Dodd Man back to the show right after this quick break.
Welcome back. Now we'll look where markets ended a week where we saw a couple of days of new record highs for stocks, along with gold and Bitcoin as well. We had the minutes from the last Federal Reserve meeting showing officials are divided on how many rate cuts we will need by the end of the year. And the third quarter earnings season is about to kick off with the major banks reporting third quarter numbers on Tuesday. Joining me now is Prairie Operating Company Market Strategy Executive Vice President Lou Basenese. Lou, good to see you.
Good to be here.
Thank you so much for being here. So what is your expectation for the third quarter earnings season?
More of the same, which is companies continuing to beat expectations. I mean, analysts have been woefully behind, and we're not just talking about Mag 7. I mean, Mag 7 companies have been growing earnings by double digits for quarters on end, but we're now seeing the rest of the market play catch up. Estimates are for about a 6% growth, but last quarter they were for the same, and companies delivered almost double that. I think we're going to see that again, and that's the key here in this market. There's a bubble in bubble talk. I mean, Jamie Dimon, Goldman Sachs, all warning about uncertainty and pullbacks. But the reality is the driver of the stock market has always been earnings, and earnings keep going higher, and they're accelerating. And I think it's going to continue that way because we're finally going to get the impact of President Trump's policies and administration and him just delivering on all of his campaign promises, from deregulation, from passing the tax cuts, to everything in between. You're seeing world peace, right? I mean, all these things that are fundamentally positive for the market. And I mean, I sound unashamedly bullish, which I have been for months, but I think it's really going to get better from here. Welcome back to the Big Skinny with Lou Basenese, where we've been discussing why oil prices are not going to go to subterranean levels like they did during COVID. We got a few more questions to wrap up. One from Kyle: when will we see the Series F preferred be redeemed? This is referring to that pref that Ed was talking about, $150 million pref that let us finalize a $600+ million acquisition. So that pref has terms on it where we need to redeem it before March 26th, I believe, the closing date of 2026, within 1 year anniversary, to avoid some additional dilution. Without giving you any material non-public information, sticking to our public comments from our CEO, we are endeavoring to have that done to minimize the dilution. Very little of that has converted out, as Ed shared during this interview and through previous interviews. So yes, again, that was the financing that was was available, and we're looking to be opportunistic in this market. Next question about me and Prairie. Why aren't you buying any shares? Well, I know. How dare I? I've been on here banging the drum on Prairie, advertising for Prairie, and I don't own any shares? No, that's not the case. Here it is. It's a technicality. When you look at insider buying, you have to be a Section 16 insider. I'm actually a Section 16 insider. I'm exempt. That's it. That's all I got to say. I'm exempt. So my purchases do not show up in Form 4 filings like they may in other companies. Not every executive on the team, based upon your involvement, is required to file. So again, as Ed said, all of us, by and large, have been buying every time the window opens for insiders. You've seen board members buy, you've seen executives buy, including myself. You just don't see the Form 4s with that. So again, you learn something new. For those of you that aren't, nuanced in SEC filings, there's a little tidbit for you. If you're exempt, the filings don't show up. But Kyle, appreciate you asking the tough questions. We're never going to shy away from them here. Appreciate you joining the show. I also appreciate the next guy that's going to join the show because he keeps this thing fun and entertaining. The Dodd Man, good to be with you, my buddy.
Hey, Lou. Kyle's coming for you, man. He's got some questions.
He does. I
think
like
we need
it,
a segment
man.
of the show called, it's not Dodd's got questions. We got Kyle's got questions.
Kyle's got questions for Lou. Listen, man, as a kid from Jersey that's dealt with it all, come on, bring it. Let's go. I'm not ready. I'm not afraid to throw down or at least answer respectfully because I thought those were fair questions. So all good in a day's work on a Monday in the markets, my friend. But I know what time it is. It's time for the high five, right?
Let's do it.
Let's go. All right. I promise that, this part of the show can't be as boring as eating a kale salad diet. So let's get to it. Let's make it spicy.
You think you got all these today? We got 5 here. You got them?
I nailed it, buddy. Nailed it.
All right. Crypto crash.
Yeah, we just lived through a massive and historic liquidation on Friday in the crypto markets. Over $19 billion got liquidated and obliterated. Part of me, I tend to be a sympathetic guy, but I don't have much sympathy here for these people. If you look at it, a lot of them were using 20 to 50 times leverage. I mean, think about that. That's like saying you had $1,000 to invest and you borrowed to invest $20,000 to $50,000, folks. That is just stupid, right? You play stupid leverage games, you win stupid price prizes, you get liquidated. That's what happens. So, boom, bust, and back up. I mean, the upside to this is that you cleared out all the just degenerate gamblers in the crypto space, and now it's true, real demand. And again, I don't want to make light of it. I mean, kinda, I do, because it was idiotic. They shouldn't have been trading that. So when they woke up and their $10 million account was zero, how in the world? I mean, Dodd, let me ask you, if you had 10 million in your account, would you put it in single crypto, a fart coin, a Doge coin? I mean, is that where you're going to keep your wealth? I think you're asking the wrong.
You might be asking the wrong guy. No, 10 million into fart coin? No, I don't think so. But Friday for me was like, it was a reality. That I'm happy that I'm not in crypto, because I probably would be buying those stupid meme coins to go, try something crazy or whatnot. And it just got canceled out. But there's a bigger story here I wanted to talk to you about.
Yeah. Which is
President sends a tweet and the whole thing crashes. And then, a few days later, he reels it back in and everything's saved. Like, is that not the bigger story here?
No, I mean, the bigger story, we flashed it up there, it was Jim Cramer said buy crypto. That's why the market crashed. It wasn't the president's tweet. It's Mr. Cramer being the contrarian indicator. No, look, I think you bring up a really good point. Nowadays, information can flow super fast, instantaneously out there, and the president's tweet or truth or post, whatever you want to call it, crash the market. Because why? The markets hate uncertainty. So when you go from, hey, we're on a path with China to come to a trade deal, to now screw it, we're going to jack up tariff rates by an extra 100%, that creates a lot of uncertainty, which leads to a lot of people taking risk off the table. But here's the thing I would say, and I said this today on Yahoo Finance appearance, uncertainty sucks for the markets, but uncertainty is gold when it comes to negotiating in politics, right? When you're the person you're across the table from, you're trying to strike a deal, doesn't have a clue how crazy you might be, it really works to your advantage. So I don't fault the president for using the leverage that he has and using good game theory to get a good deal. So, yeah. Expect more volatility is the bottom line.
All right. Well, hopefully it ends up in our favor.
Yeah. Well, today, if today's an indication, everything's back to normal. A lot of the stocks we own, a lot of the AI energy stocks, rip-roaring right back to where they were last Thursday.
Which brings us to our next one, AI energy.
Yeah. We have been talking about these stocks, and for people that haven't been listening to the show for long, or if this is your first show, we've been really driving and diving into this trend. If you bring up this chart, we show the names here, the available capacity. Our top pick here that Eric Jackson put us onto right after the win for Core Scientific was IREN Limited. The green bar is what you need to focus on. That's their available energy capacity that they can sell essentially or rent out to the AI hyperscaler. So, but if you go across the list here, you got Core Scientific in the middle, has a ton. TeraWulf, we had the CFO on last week, so they've got a lot of capacity left there. And then Cipher Mining. So plenty of names with plenty of upside. These things are hitting new highs today. I think they're going to keep hitting new highs.
And great point here, or a question for you is, I'm obviously.
Oh, you can't give me the great point. It's just a question.
You have a great point, Lou. Of course, you always have great points. But the question is, IREN and Cipher and Wolf and even CleanSpark, I've heard of those. I have, owned some of those, but there's some other names in there. Are those that I'm unfamiliar with? Are those good to invest in? Or is there an ETF by chance that anybody can invest in all of them?
Great question. No, there's not. Maybe we should start an ETF that is nothing but the AI utility scalers. Here's what I would tell you. There's a lot of these companies, pretty much without exception, that started off, Galaxy's newer, but that started off as Bitcoin miners. There's some skepticism that all of them can make the pivot from doing Bitcoin mining to AI compute. So Riot, I believe, has been primarily Bitcoin. I don't think they're actually going to go into AI compute, but there's the potential. So all of these, this comes from Bernstein, are looking at if they used all their excess capacity for power and got into AI. So right now, I think the top picks based on all the research I've done is IREN and Cipher for sure, and TeraWulf. TeraWulf had that huge deal and re-rated from 4 to 8 plus. So I think Cipher and IREN are the ones that have in the near term the most upside potential and are the most undervalued.
Good to hear. All right, retail ramp.
Yeah, retail revolution. We talked about it last week. Here's just another data point. We don't have to drive this one, belabor this point. Looks retail buying surge, rolling 1 month demand in billions of dollars, topped over $100 billion in the last month. So that's a lot of buying from the quote unquote dumb money. That doesn't look so dumb.
Well, I think that that's only growing. The retail revolution is absolutely happening. That's clear. Isn't that clear just from the, once again, I say it's the tweet that goes out and the market changes. That's not institutions turning on a dime after hours. That's, individual investors, making a big,
you're exactly right. It
so.
Used to be we'd follow hedge fund filings to follow the smart money. And now the smart money is having to follow the quote unquote dumb money based upon tweets and positioning. So retail revolution's here to stay. And that's why we're here, hopefully, to stay.
I think the next wave is the numb money, what I'm calling the numb money.
What's the numb money?
It's all the people that learn to invest from their their parents and their grandparents that are basically they're going to watch their kids pass them up because they're betting and investing in different ways. So I think there's a whole center sector that are going to start changing from their traditional investments and following what their kids are doing.
Yeah, I don't.
What do you think?
Do I
have a leg to stand on here?
You do have a leg to stand on, except I think you're helping your kids invest right now and having them follow some of our trades. So I take no accountability for that. What you give them the guidance. So, but I'm just kidding.
Well,
I think you're absolutely right. We had that wealth chart not too long ago where there's going to be a massive transfer of wealth. That if I was a financial advisor or wealth planner right now, I'd be freaking out because the younger generations, as you point out, are self-directed, sophisticated, figuring it out, and they're not going to go to the Edward James office to manage their inheritance. They're going to go, man, this is awesome. I know exactly what to do, and I'm going to do it on my own.
I agree. Earnings surge.
Yeah, look, this is a chart we're just going to keep refreshing. Everyone counted small caps down and out, but then stock prices ultimately follow earnings. And if you look at this, the far right, small cap earnings growth is expected to go off the charts practically from a negative 11% this current year to 14% next year to 42% in 2027. So buy that IWM Russell 2000, and if you don't do anything else, it'll give you exposure to 2,000 compelling small cap companies in one investment.
IWM, so that's just all small caps.
All small caps. It's all you're owning the index, so you get all the winners and losers, but across the board.
Got it. All right, biotech boom.
Biotech boom. Look, this is not a chart or a data point. This is anecdotal, but it's also sentiment based. Adam Furstein, if you don't know him, writes for Stat News, is one of the most, just brutally honest journalists in the biotech sector, but he knows it better than anyone else. When it's good times in biotech, it's great times in biotech, both for shareholders and for the journalists, because they're reporting on drugs that are saving lives, changing lives, and generating billions in revenue and profits for investors. Reading it right from him, it's starting to feel like old times. Well, bring it on from his mouth to the market's ears, please. Let's go. Biotech boom. Here too, you could buy the index XBI. That gets you a portfolio. I think it's over 163 maybe, compelling biotech names. Or if you're a degenerate speculator in crypto and you like to use leverage, you can buy the LABU, L-A-B-U. It's 3 times levered to the XBI. So if you blow yourself up, it's not my fault. I've warned you. But you could take, instead of just the XBI, you can get 3 times that return if you buy that ETF.
Let's push more people to the XBI. I think that's probably smart.
Yes, I agree. XBI over LABU, even though LABU rhymes with Lou, and it would be more fun to buy LABU and win big. But we're buying XBI, and we're going to be talking about a lot more biotech's individual names that aren't in the XBI that can increase your bottom line in the months and quarters ahead on future episodes. But before we jump the gun there, let's go to the game, man. How'd I do? Am I buying drinks tonight, or are you buying drinks?
I got to be honest with you. I don't think you did fully well today, did you? I might have missed some. So
I nailed them all, dude. I don't miss.
Well,
I'm like Steph Curry with a basketball, but random words. I can't.
All right, I'm gonna have to take your word for it, because
Ubiquitous was in there gingerly. The official scorekeepers might have to go back and review the transcript, but I'm saying you can go.
We're gonna have to go to the tape.
It's gonna be in there, and you're buying me drinks next week. So,
all right, sounds good. I trust you. I think you must have nailed them all. I had a little tech difficulty in the middle. I had to kind of jockey around some things, so I think I missed the middle segment. But
well, listen, man, as always, appreciate you, and appreciate you, our audience, for tuning in and hopefully getting some insights that increase your bottom line. We'll be back at it next Monday, same time, same big skinny channel. Lou Basenese signing off.
See you later.